Yeah, I'm losing my
Let's
head.
transition into a quick segment today on reducing risk with call options. So we're looking at the same call options that you and I are using as part of strangles, as part of short selling strategies to try to add speculation, to add risk on our books, but also try to profit from. Let's use calls today as a vehicle for reducing risk in volatile times like we're seeing. And we're going to zero in on this volatile metals markets. Futures let you buy or sell outright exposure for less capital than stocks. Great, awesome use. But Jermal, they, especially in times like this where gold, the next stop, no one knows, selling a futures contract is a little daunting, right?
Yeah, it is. But those are the risks we take, Frank.
Yeah.
And these are some of the best vehicles to be able to do such things. Again, we're having some quasi end of the world like activity taking place, and these are the markets that we've really been sort of waiting for since, let's be honest, since we had the pandemic. There's a lot of people who are like, oh man, I wish I did this. I wish you're getting another opportunity fairly recently, and it doesn't happen often.
And if you aren't into, obviously, you and I have been around markets for a while now, and we're cool with taking that risk, like diving right into the futures. And if you're good with it, that's good on you. The small exchanges created some smaller vehicles for taking that full outright risk, but you can actually use call options to diminish long risk in a market like this, where it's like, maybe I'm long a bunch of metals from yesterday. I'm up pretty good today, Jermal, but if they fall through the floor next week, maybe a lot of these, political stresses, they alleviate a little bit. I don't want my investment to really kill me here. I can drop down the full risk by selling a call against my long investment. And that's just the covered call. Maybe you can walk through the variations of covered call. If I'm long something and I sell an in the money call or an at the money call or out the money call.
Yeah, so it's nice because they give you have, as you've laid out so perfectly here, you have these different options of different ways of selling call, depending on how you feel about your current risks. So to be able to sell an in the money call, that's a big hedge. Again, those are higher delta. There's small upside on that situation because of the fact that you're selling an in the money call with higher delta. If you're selling at the money, you're kind of like, the thought process is like, I don't know how I feel about it, but I also feel like I have a little bit of risk on, and I think this thing might fall relatively fast. So I at least want to have some type of, movement on it, and at least some type of hedge on, and then that makes you feel a little bit better. And then finally out of the money is like, well, I think this has some room to run. And all three of these just depend on how you feel about your current, trade or investment. Exactly.
Yeah. The spectrum really runs. If I'm long something from, in this case, maybe I bought at 78 and I am really fearful of this falling down to, like 75 or 70, I can sell in the money calls, make a little bit of money if the market stays here and moves higher, but I have a big hedge on because I'm getting a big call price that I'm selling at the money, medium version of that. If I'm selling calls up at 85 or 90, I'm putting a little hedge on, which is nice. I'm bringing down the risk. I'm reducing risk here, but I'm not reducing so much risk, and I'm leaving myself a lot of profit still to the upside. Similar scale here in buying calls. You could forget trading the outrights completely and just look at using calls as a vehicle to get long with the long call. And I can have for myself another kind of spectrum of risks. But this time, the thing that's changing is my probability of profiting. Jermal, maybe you can speak a little bit to how, if I'm buying in the money calls as opposed to out the money calls, how my probabilities shift. But how the money that I put up also shifts.
Yeah, I mean, this used to be probably I used to really be more of a call buyer than anything. And this is definitely something that I used to do quite often. And so again, the thing with this is that, probabilities are not necessarily on your side when you're buying calls, but again, to each his own. Sometimes, in this type of market, and you see the move we had here in Spree more recently, you could have probably profited in this type of situation, right? Mm-hmm. So it just all depends. But in the money is a big probability, but it's also a big risk because, again, you're paying higher premium for an in the money call. And so should in this case, should Spree fall, then you're going to see a big diminishing value within the call that you own. If you have an at the money, again, medium probability, medium risk, you're not paying as much as the in the money, but still an at the money is typically largely an extrinsic value at that point, right? And that you're paying for that call. So you have to worry about, again, more of the situation where the spree falls and then you're losing basically all your extrinsic value. Out of the money is 100% extrinsic value, usually a smaller premium, usually a smaller probability of making money on it, and therefore also a small risk. So, these are kind of all the things you have to think about when you're buying any one of these type of 3 calls. Yeah, buying in the monies is almost like a replacement for buying the thing itself, but it's defined risk. Like if I buy the 70 calls, I'm putting up, $10 to do so, a lot of money. But I pretty much have 100 deltas there. If I'm buying out of the monies, it's like you're taking a flyer. Like the thing needs to really go higher, but I'm only maybe putting up $1. Now, last thing here, you can also get on the other side of that exact concept with selling calls to create lower risk shorts in this market, especially interesting to us with the rising metals market, call skew. We're contrarians, like to get on the other side of, outlier moves like this. We've been looking at selling calls in spree a lot recently. And maybe to finish up here, Jermal, you can walk us through the idea of like, if I'm selling in the money calls, then, I've got essentially a big risk here as opposed to selling out the money calls. My probabilities with selling calls is almost always going to be higher than 50-50 as opposed to selling that outright. But you get higher probabilities as you get out of the money, correct? Correct. And we're just talking about with no future, right? Just outright just selling calls. Short right? Naked calls, yeah. Yeah. I mean, again, completely the opposite of what we just talked about a second ago. And while a lot of people may look at this as like, oh, it's similar to being short the future, for example, the big difference is lack of margin, right? There's no margin when you're just selling these calls in this situation. So it is, I don't want to say, they're different risks in general, right? And so selling it in the money call, small probability, but big potential, dollars. You're basically short the underlying market. You're short the underlying market. You've got a little bit better probability. And these are undefined risks. Exactly. Like you can work up to the risk of the full underlying market, but at least starting out, you got a higher probability and a smaller potential risk, especially with the out of monies that we focus on so often.